Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Armed with the power of the terminal and bringing together a gift for writing and a deeply curious mind, Cameron Crise is a macro strategist at Bloomberg, contributing pieces on the big picture topics investment professionals are wrestling with. The author of the Macro Man column, Cameron utilizes a framework developed over years on the buy side in portfolio management roles in which managing interest rate and FX risk were among his primary responsibilities. Through our conversation, we gather Cameron's views on some of the overarching areas of uncertainty, focusing on the U.S. interest rate vol surface and what it tells us. In this context, Cameron emphasizes the degree of uncertainty via elevated options prices embedded in the shorter maturities of the curve, ultimately a result of how much work the Fed has ahead of it. We talk as well about pricing incongruities, and here he notes that the equity market multiple has not contracted nearly to the degree elevated inflation would imply it should. Lastly, Cameron points to curious differentials in the Euribor versus Eurodollar curves. Here he notes that even as forward prices suggest the U.S. may shift from an aggressive tightening cycle to actually easing in 2024, the Euribor curve implies ongoing tightening during this period. According to Cameron, the ECB has never actually hiked rates as the Fed was actively cutting, as is priced in 2024. Something to think about. I hope you enjoy this episode of the Alpha Exchange, my conversation with Cameron Crise. My guest today on the Alpha Exchange is Cameron Crise. He is a macro strategist at Bloomberg, also known as Macro Man. Cameron, it's great to have you on the podcast today.
Thanks for having me, Dean. It's a pleasure to be here.
Looking forward to the conversation. Really enjoy reading your work on a nearly daily basis on the terminal, diving into all of the particulars about macro. And we, of course, live in these very unique times. What I'm hoping to do, first and foremost, we'll learn a little bit more about your career trajectory, how you got started in the markets. We'll do a little bit of history in terms of risk events, and then just dive into what we see now in terms of the set of prices we look at each day. So let's get the conversation started. Tell us about your early days. How did you get started in this wonderful world of finance and markets?
Well, it's kind of a convoluted story, but I was studying abroad in Scotland in 1992, which is when sterling was ejected ignominiously from the European exchange rate mechanism. And at that point, I'd kind of so sterling versus the dollar was 2 when I wired my beer money over. I got filled at about 185, and it was sort of 160 by the time I left. And this was a famous episode where George Soros made $1 billion betting against the Bank of England back when $1 billion was a proper amount of money. And that sort of piqued my interest in foreign exchange. And I graduated 8 months later from college and ended up getting a job in Chicago with a firm called O'Connor & Associates, a very well-known option market making firm, to work on the Merc in FX options. If you'd asked me a year previously if that's what I'd be doing, I wouldn't have said that, but that's how I got into it. And from there, it turns out I ended up being a pretty lousy market maker, but I did enjoy sort of analyzing markets and what was driving markets. And the analogy I use is that to be a good market maker, you have to be a good poker player, where a lot of your success is about reading the other players at the table. Whereas I preferred more of a sort of, if you will, blackjack approach, which is sort of an objective analysis of probabilities and future outcomes based on the current state of play and sort of leveraging those probabilities to my advantage in terms of making market calls. So I was naturally drawn to that side of the business. And I ended up, at this point, O'Connor had been bought out by Swiss Bank Corporation, and I joined the FX research department at Swiss Bank to sort of bring a derivatives fluency to the FX research. Soon thereafter, Swiss Bank merged with UBS. They sacked the main FX strategy guy at Swiss Bank. The UBS guy quit, and sort of there was me left holding the bag. I didn't really have much training in sort of traditional macroeconomics, but I was a pretty good writer, and I could kind of blag my way through it as I bought a bunch of econ textbooks and the Rosenberg book on exchange rate determination and figured out what I was talking about. And so I ended up being an FX strategist for 3 years in London and then got headhunted to join a buy-side firm doing FX overlay in Ireland. So I went to do that. I was there for 3 years, moved back to the UK, had a couple of jobs in long-only asset management, running currency portfolios, creating an investment process and what have you. But I kind of knew at this point I wanted to get into macro. So in the mid 2000s, I started this Macro Man blog where I basically began running kind of a model portfolio of macro trades. And in early 2008, I ended up getting a job at a macro fund in London called Nylon Capital to run a macro book, which was interesting timing to say the least. Had a great couple of years there, but unfortunately, a large bank was the main investor. And as I'm sure you can recall, after the GFC, large banks weren't really allowed to be in the business of having big hedge fund stakes anymore. So the fund had to close. I moved to the States to take up a similar role at a hedge fund here in the States. I was there for 4 years, had some success, had some not so successful times, ended up leaving, and somehow ended up basically at Bloomberg doing a lot of the same stuff I used to do as a PM in terms of analysis and thinking about the market and how the interplay between global economics, policy, and financial market pricing. But instead of putting trades on and managing risk and portfolios, now I just write them up and move on to the next analysis.
Well, I appreciate the sharing with us the journey to where you got now. And I'll say your column is one I think that consistently gives us things to think about, which, of course, because no one has anything close to a crystal ball, is really all you can ask, is getting us to think about, as you referenced there, perhaps the interaction between policy and positioning and prices. So kudos to that, and kudos to the consistency with which you've been an author. I want to go all the way back to the start because it's a fascinating start just from a timing standpoint, and something that gives us just a lot to think about, which is this Soros confrontation with the Bank of England. Those are very, very different times, and mechanisms are constructed in much different ways. The central banks seem pretty deep-pocketed these days, but perhaps there are some corollaries, not that there's a bank that's about to be broken, but that this force of inflation is so rampant that you are starting to see instances in which central banks kind of back down. It happened with Australia a few months back, that market prices are now dictating things ahead of the central banks, which is kind of opposite of what we had for years post the financial crisis. I'd love to get some of your perspective on what you see now in the world of central banks and market prices, and perhaps weave into it what you saw way back when in the early days of your career.
I think it's an interesting contrast. I would actually raise another episode that I think is also instructive on how the business has changed over the years, and that's the breaking of the S&P peg in 2015. And I think it's a real lesson on how sort of the market's mindset changed, particularly after the financial crisis, that in the 90s, currency pegs were essentially seen as targets for macro investors, traders, or whatever you want to call them, to challenge when they were not economically justified. But if you look at the losses that were incurred when the S&P peg broke, that kind of suggested a market that almost had been cowed by central banks, was used to being dominated by central banks, and were thus less wrong-footed when the rug was pulled out and the S&P pulled the bid on the euro. But if we fast forward to today in terms of policy, I think, if you will, the market has its mojo back. And as you suggest, it seems as if markets have been leading central banks in terms of identifying, to some extent, the appropriate direction and magnitude of policy in response to what for many people has been an unprecedented set of circumstances. I mean, you have to be pretty, shall we say, veteran, at least if you're a developed market investor or trader, to have experienced periods of elevated inflation that merit a substantial monetary response. The EM crowd will be a little more familiar with this through various journeys along with Mexico and Brazil and Turkey and India and Indonesia and the like.
There's a lot of discussion these days in so far as monetary policy, and especially the slope of the short-dated part of the yield curve, quite upward sloping. We haven't seen anything resembling 250 basis points of implied tightening in quite some time. So it all feels very new. But I was hoping, again, just by virtue of the history you have in markets, perhaps to go back to that 94 episode for the Fed, an aggressive hiking cycle. There's a lot of folks trying to draw inferences and conclusions from that, saying that, of course, it was a little disruptive for equities. But once we got past, I think it was a 75 basis point move, the S&P was kind of off to the races. When you look back at that period specifically, what's similar now? What's different? What's useful to you in terms of that period from a comparison to today?
I'm not sure if there are that many analogs. I mean, obviously, the top level one of, the Fed's going a lot is a superficial similarity. But I think if you look at, obviously, the underlying inflation dynamics, they're considerably different now. If you look at the entire Fed framework in terms of its forward guidance, that is considerably different. I mean, if you recall, the 94 cycle was a breakthrough in terms of transparency because the Fed actually told you what they were doing. Prior to the 94 cycle, when they moved policy rates, the only way you could tell was by assessing conditions in money markets, as the open market desk sort of added or drained liquidity to see where they were sort of targeting the Fed funds rate. So insofar as we now have the dot plot and the sort of stream of consciousness from Fed speakers sort of updating you in real time about their latest thinking, I'm not sure how apt the comparison with 94 actually is. And from a equity market perspective, I think the starting point in terms of valuation is also kind of radically different. From that perspective, it's more like the 99-2000 cycle, given the relatively elevated starting point for stock prices and the easy financial conditions that are prevailing.
When you look at the yield curve now, you've got, as we were saying, a lot of slope out to perhaps the 2-year point. And then at some point, you actually start to price in a small number of cuts, maybe a cut and a half type of thing if you're going 25 basis points. What's your read on that? What is the yield curve telling us now? And to what extent do you think the signals are clean versus perhaps impacted by various external factors, the Fed being one of them?
Well, I think what's unprecedented this time versus certainly pre-GFC is the Fed is telling you where they think neutral is. It's at or slightly below 2.5% on a nominal basis. And so the dot plot itself and various individual speakers are telling you that they plan to get to neutral expeditiously, is the word that they've apparently agreed upon to characterize this cycle, and that they're almost certainly going to go beyond neutral into restrictive territory. Now, if you look at any sort of history of Fed policy, once they go restrictive, whether you're looking at an R-star model, the Laubach-Williams model, what have you, or a Taylor rule framework, once they go restrictive, they tend not to stay there very long before reversing. So from that perspective, I guess it's rational to some extent that the market is expecting them, once they go restrictive, to eventually unwind that with relative alacrity. Where I would throw open a question, though, is just how much confidence we can have in this notion that neutral is somewhere around 2.5%, insofar as that's predicated in the long run on inflation being around 2%. No one expects inflation to be 2% over the next year or two, in which case for a given real neutral rate of, say, 25 to 50 basis points, the implication is the neutral nominal rate would actually be quite a bit higher. So I think you could argue that even though they'll be raising nominal rates quite aggressively, the real interest rate, which theoretically is what should matter, I think, is still going to be broadly accommodative. It'll be less accommodative than it's been in the past, but still accommodative. So I think there is a chance that the market is underestimating the magnitude and therefore the duration of how high rates will need to go.
I want to get your take on the set of vulnerabilities that we are faced with now in markets and the economy. There's always something. And what's, I think, so fascinating about our jobs is that they're always changing in kind of form and character. I'd first love to get your thoughts on the inflation break-even curve, which is, as opposed to the nominal yield curve, which is quite upward sloping, at least at the early stages, the inflation break-even curve is deeply backwardated. And I think that's quite interesting. And I just love to get your thoughts on that.
Yeah, I mean, I think it makes sense. If you believe that the Fed will have at least some success in curtailing inflation, some sort of eventual gradual mean reversion toward long-term norms makes plenty of sense. Most people, I think, agree now that we're at the peak of year-on-year inflation because of base effects and stuff like used cars starting to roll over and a little less inflation on the goods side. But that doesn't mean that marginal inflation moving forward is going back to 2%. One-year inflation swaps are 5.3% or something like that. And the thing about inflation that is very interesting is it's a lot like volatility. And I think the two are actually intertwined quite closely insofar as elevated inflation kind of naturally begets more real world uncertainty and thus is a catalyst, if you will, to financial market volatility, as we're kind of seeing in fixed income now. So that's one aspect of it, but also both volatility and inflation tend to be autoregressive in the sense that over short observation windows, they tend to cluster. If volatility was high yesterday and it's high today, statistically speaking, there's a very good chance it'll be high tomorrow. Historically, if inflation is high yesterday, is high today, it will be high not only tomorrow, but next year. Now, what's curious about the 21st century, a time in which the Fed and other central banks have been complaining that there's not enough inflation, is that they actually achieved what you might call the holy grail of price stability insofar as they broke this autoregressive tendency of inflation. It was low and broadly stable. And so the only iterations that you had or perturbations in year-on-year inflation rates were largely random noise. But now that we've sort of broken the seal on how high inflation has gone, and that seems to have fed through into wage demands and wage settlements on the part of the labor force, there is certainly a risk that we return to the 20th century autoregressive nature of inflation, which I guess an economist speak would be that inflation expectations become unanchored and then feed through into more inflation in the future. And thus that the notion that we will swiftly return to a stable 1.5% to 2.5% inflation regime in the shorter to intermediate term is misplaced. And I think the market pricing essentially reflects that. Forward inflation is lower than spot inflation, but it's still above the Fed's target, as it were. And you have to, even 5-year now, is pricing inflation on a headline basis of 2.6% for CPI, which is equivalent to something like 2.2, 2.3 on headline PCE. So yes, the inflation curve, the break-even curve is downward sloping, inverted, but you could argue that even that is suggesting that the Fed won't quite make it to its target, which I suppose then feeds through into this issue of, does it make sense for us to be pricing rate cuts starting sort of late next year? Possibly not.
You make some great points there in terms of the similarities between vol and inflation. I've made some similar points just in observing the way in which inflation on a realized basis, and certainly the implied distribution of inflation through things like inflation options, goes up as inflation goes up. The same exact thing happens to the VIX. If I look at October VIX options, there's 100,000 options on an open interest basis north of the highest all-time close in the VIX, which was 83 back in March of 2020. There's 53,000 options struck at 150 in the VIX that are open. So no one's buying that thinking the VIX is going to 150. They're buying that because along the way, on a mark-to-market basis, that could be a pretty convex instrument. And it sort of leads me back to this idea that I'd love to get you to riff on, which is the Fed's interactions with markets. A lot of people like to throw out the idea that the Fed has been a big dampener of vol in the markets over the GFC, perhaps to 2020, maybe that 10-year, 12-year period. But that something's changed, that the Fed's ability to guide the market along has been compromised by inflation. The Fed's kind of almost a buyer of vol now. I'd love to get your thoughts just on that, the Fed's interactions with markets and perhaps the outcome from a volatility standpoint.
I think that summary is just about spot on. The point that I've made for years is that it was dangerous at best for central banks to be hankering for a sustained rise in inflation, because this notion that they could just get it to just where they want it and then Goldilocks-like sort of level it off was always hubristic at worst, I guess, and hopeful at best. But the phraseology that I prefer is that the problem with inflation is that it makes central banks tighten because they have to. Whereas in a low inflation environment with price stability, they can hike because they want to. And when they hike because they want to, they control the pace. They control the magnitude. As soon as things start to go a little bit awry, they can ease back, as we saw in 2019. With inflation as elevated as it is now, clearly 6 months ago, if you'd asked them, are you going to be putting rates up 50 basis points several times in 2022, they would have said, you're smoking crack, or the flowery central banking equivalent of that. But here we are. And the reason is that inflation has forced their hand. It's gone much further than they thought it would on a headline basis. And perhaps more worryingly, it's become much broader, I think, than they were expecting. If you look at stuff like the Cleveland Fed median CPI, you've seen a real broadening of price pressures, which makes it a lot more likely that those are sustained into the future. And so they've kind of had to revert back to not just pre-GFC mentality, but really kind of pre-Greenspan mentality. We're not quite at Volcker yet, but this isn't the Bernanke Fed, this isn't the Yellen Fed, and this isn't the first half of the Powell Fed. They are moving because circumstances are forcing their hand. And traditionally, when circumstances have forced their hand during our careers, it's because of some sort of economic or financial market stress. And so naturally, their response has been one that's been trying to, if you will, put a floor under the economy, put a floor under financial markets, thereby dampening volatility. This time around, they're trying to dampen inflation. And the only levers that they really have come on the demand side. And that, by negatively impacting demand through the price of money, that's naturally going to be a volatility amplifier, as you suggest. And I mean, it's extraordinary that Powell himself, in his press conference in March, basically, I'm paraphrasing here, but basically said, yeah, policy tightening is supposed to tighten financial conditions. I mean, when was the last time we heard a Fed chairman or any Fed speaker talk in positive terms about tightening financial conditions? It's been a long, long time.
It's quite interesting, and Dudley has made very similar points. And if you regress the GSFCI on the S&P, you're going to see about a minus 75% correlation. So it's
but you'd expect that because the S&P is a big part of the Goldman Index, right?
Of course.
So essentially, regressing the S&P against itself.
It's a lot of base rates. It's something like 40% of base rates, and then credit spreads as well, which that's very close to the S&P. It's them kind of laying out, in some ways, the roadmap to saying, look, in some ways, lower asset prices are going to be a price to pay here. I'm curious if you can describe in your rendering how we got here. We had some deglobalization already occurring before the pandemic with the Chinese trade war. The pandemic is a huge shock, and you sort of had to throw the kitchen sink at this thing from a fiscal and probably a monetary standpoint as well, if markets were to get revived. And it all came about as the Fed had embarked on this flexible average inflation targeting framework. What are the mistakes? What do you see them as liable for in some way? And then how much of it is just out of their control?
That's a good question. We always have to be careful here because hindsight is always 20/20. And so it's very easy to criticize people who are at the coalface of trying to save the world, as it were, in retrospect. I think we can probably agree that the CARES Act was A, necessary at the time, but B, somewhat profligate in the way it hurled money at small business owners, some of whom didn't actually need it, at least judging by some of the conversations I've had with friends who run small businesses, almost all of which I think has turned into grants rather than loans. So it's essentially a massive cash drop on the moneyed class, as it were. Probably the later iterations of the stimulus payments, once the economy had begun to repair itself, were also superfluous, at least to individuals of a certain income level or demographic group. As one data point anecdote, when I went in to do my taxes with my accountant last year, he said, well, have your son file, college-age son file, he'll get his stimmy payment. So yeah, okay, we filed, he got his payment, took the money and went to Europe over the summer. I mean, he didn't need the money. He's glad he got it, but that sort of money drop, I think, was maybe a little OTT. Then on the monetary side, obviously, the Fed, whatever it takes to steal the you can't really criticize. I think even at the time, it's probably safe to say that they didn't really need to buy credit ETFs. That was probably overstepping the bounds a little bit. But the fact that they maintained QE as long as they did and as aggressively they did was, I think, pretty clearly an error in real time. And now, even in retrospect, they themselves have admitted that they wish they'd started normalizing earlier. So we had this sort of unprecedented fiscal windfall for large segments of the population. At the same time, we had an unprecedented monetary stimulus. So is it any surprise that demand went through the absolute roof? I mean, this notion that the inflation we're seeing is primarily a function of supply is just flat out wrong. If you look at nominal spending levels, they have shot up way, way, way above pre-COVID trends. If you look at income growth, nominal income growth, it's shot up to kind of unprecedented levels on an aggregate basis. Now, that should obviously come lower as stimulus payments fall out of the base effect. But even if we just look at wages, aggregate wage growth across the U.S. economy is running at more than 11% year on year, essentially combining payroll growth with individuals' own wage growth. So if the aggregate wage income of the U.S. public is rising at 11% per year or more, it makes sense that nominal spending is at least close to, say, 10% year on year. And in the absence of a supply response, which is then when we fold in not only the deglobalization because of China, but also obviously because of COVID, and then labor market supply constraints, which are a sort of a complicated question themselves. That's how we've ended up where we are in terms of inflation. This massive stimulus, massive income, and then you add in the supply constraint. Will they get better moving forward? Yes, but again, we're not going straight back to where we were 5 years ago. It's going to be a slow process, and it might be a very, very long time before we see wages back to where we were a number of years ago, if and as those inflation expectations become entrenched and people essentially say, if you want me to go into the office, you're going to need to pay me more.
But let's talk a little bit about vulnerabilities by way of market prices and the potential that they move fast. And I'd love to get some of your thoughts on FX. We're coming out of this period where central banks did a ton. The U.S. central bank might have done the most, and it's taking it back perhaps at the quickest pace as well. And that's having some reverberation throughout the world. When you look at the FX markets, what's top of mind for you just in terms of where we could see some spillover?
I think we're already seeing it in the yen, which, I mean, it's kind of a classic macro trade. It's ticked all the boxes for sort of the last 10 or 12%. You had the interest rate differential story, which is obviously a big driver traditionally of dollar yen. You had a terms of trade story in terms of Japan being exclusively a commodity importer, the U.S. being broadly in balance when it comes to crude, but an exporter of many other commodities. So essentially enjoying the benefits, reaping the benefits of the commodity price boom. And so there was also a massive technical level around 115, 116 on the long-term chart. You broke there, and bang, you were sort of off to the races. Did anyone expect that you'd be up 13 days in a row in dollar yen? Probably not, but here we are. Is it going to continue forever? Of course not. Again, it's one of these things, kind of the theme of the year, I think, for policymakers is be careful with what you wish for because you just might get it. For years, the Japanese have wanted higher inflation. They've wanted a weaker yen, but it's come in a guise that has been uncomfortable for them because it implies a massive hit to corporate margins domestically. And so it seems pretty clear that we're nearing a threshold where it's starting to hurt pretty badly. We're getting the verbal jawboning from the finance minister already. And some of us are old enough to remember when they actually intervened above 145 in, I guess it was 98.
And so how do you see this materializing? And just as you said, there's been some verbal intervention. That's always the first step. But what are the kind of implications if this trend, which is just so firmly in place, continues? What are the implications?
For Japan, for the dollar, for the world. What I find particularly interesting, incidentally, is that this period of exceptional dollar strength has come at a time when a popular nascent theme has been sort of the death of the dollar as the global reserve currency because of sanctioning of Russian reserves. You're no doubt familiar with the Zoltan story that commodities will become the new store of value or will move to a multipolar reserve currency world. Maybe that's a story for the future. I don't think it's a tradable story because the time horizon that will materialize in goes well beyond the P&L constraints that most people are going to have. I think people bought gold when Zoltan published his first note on that front. Gold zoomed above 2,000 and they stopped out the next day, which is a phenomenon that unfortunately we've all seen all too often. But the ECB, I think, is approaching a similar, not quite an equivalent threshold maybe, but a similar calculus in that for years, basically for at least the last dozen years, the ECB has come as close as they've allowed themselves to sort of cheerleading Eurodollar lower. But now that comes with costs insofar as they've got an inflation problem, they've got a terms of trade problem, and they've also got just a commodity sourcing problem in terms of energy. And the weaker the euro goes, obviously, the more costly non-Russian energy becomes and the more of a hit to Eurozone households and businesses.
What are the other vulnerabilities? I saw a chart just as we talk about housing and the impact to affordability on clearly mortgage rates that have risen by quite a bit. But just this notion that household debt is way down relative to the leverage that consumed the typical household, maybe circa 2005, 6, 7. When you step back and you just look at the types of tipping points that have caused market prices to gap out or caused reconsideration of the effectiveness of policy response, what are some of the vulnerabilities that pop up on your dashboard?
There's a couple of obvious ones, I suppose. The corporate debt side, in contrast to the household debt, non-financial corporate debt is kind of near record highs as a percentage of GDP. So if and when the earnings juggernaut sputters and runs out of gas, that could prove to be problematic. I think one of the reasons the equity market has held in as well as it has in the context of this rising rate backdrop is that credit markets have been extraordinarily well behaved. And there's kind of a synergy there. As long as earnings are growing reasonably well, credit hangs in there. And if the top of the capital structure hangs in there, why should the bottom of the capital structure not fare pretty well as well? I think another issue that I'm sure has vulnerabilities, but I am not the expert in articulating them, is the crypto space, given how much money it's attracted, given how many, if you will, man hours it's attracted in terms of people gravitating to crypto. If there is some significant flush out there, either on the financial side or the regulatory side, that could have, I would think, some reasonably serious consequences, at least in terms of radiating sentiment across other risky assets. As a cynic, I might suggest it could actually be beneficial. If people are trading crypto at home rather than getting a job, it could actually solve some of the labor supply issues. If everyone who holds a crypto portfolio suddenly finds themselves with no money and they need to get some income again. But that's my little snarky, cynical aside. I'm sure either you or some of your potential or former guests can articulate these particular crypto risks more elegantly than I can. It's just something that strikes me as, if not quite a black hole, at least something approaching the event horizon of a black hole. And things behave very oddly around the event horizon of a black hole.
I've always found the conversations of stablecoins and Tether to be pretty interesting. At the end of the day, all banks engage in fractional reserve banking. If everybody came back for their money at once, the system would not be anywhere close to be able to honor that. And Tether's doing something similar. They own securities that are not exactly as liquid as they might be promising or implied relative to pegging something to the dollar. It's an interesting and ongoing question.
If I could interject, I'd say the difference between Tether and the banks is that the banks have access to a lender of last resort.
Great point.
Tether does not. So in a sense, Tether is equivalent to the U.S. banking system before the creation of the Federal Reserve System.
That's an important point. Cameron, in one of your recent pieces, you make a point which I really like. You say that there's really two types of trades. One type being that which sells volatility, harvests risk premia, and the other benefits from volatile conditions. And there's an old saying out there, it's probably attributable to Mark Twain, just like everything else. And it's asked the question, is volatility an asset class? And the answer is, well, really, volatility is the only asset class. You're really on one side or another of the ledger. And no market has experienced a sea change in volatility as much as the U.S. rates market. Post-pandemic really went almost to a pegged market there, with the Fed so emphasizing forward guidance and told you nothing was going to happen for an extended period of time. And here we are now with the MOVE index in the 120s. Take us through your rendering as when you look at the surface in U.S. rates, both across time and strike, the levels. What does it tell you? Just give us your perspective on U.S. rate vol.
Well, I think it basically says that the greatest uncertainty is kind of at the short end, which I think we can put down to the opacity of the policy outlook. At the end of the day, we all have our views about where neutral rates are in terms of the policy rate and how restrictive rates need to go, but we don't know, because we don't know if it's the nominal rate or the real rate that matters. We don't know what the real rate will be in 6 months, let alone 18 months. So while, yeah, the MOVE index is elevated, certainly to where we were election day in 2020, which was also, whatever it was, a week or two before the announcement of the first COVID vaccine. But we're way, way, way below where we were, obviously, at the time of the GFC. We're way below where we were at the time of long-term capital. And frankly, we're still quite a bit below where we were at the peak of the COVID panic. Now, if we contrast that with measures of volatility at the short end, I've got a Bloomberg CIX that looks at the implied daily move from the straddle of the fifth Eurodollar contract. I'd prefer the fourth, but there's some bad data. So I've done the fifth as well. That's implying current vol of the fifth Eurodollar contract implies a daily move of nearly 10 ticks a day between now and expiry. And that's currently, as we record this, I guess the June 2023 contract. That's more or less at the highs of the last 30 years for which we have data. I mean, it's like 180 ticks in the straddle, which is pretty remarkable when you think about it. The 97 straddle on a hold to maturity basis, not mid-curve, but the terminal contract, the 97 straddle is 180 ticks. So that puts you at a LIBOR break even of 95.20, or shall I say 480 to 120 when it comes to where LIBOR will be in 15 months or less than 13 months. That's extraordinary when you think about it. A break-even range of 3.6% on a short rate that we all assumed was going to be pegged at zero 18 months ago.
It is fascinating, and it's so two-way. You certainly can make a case that as the inflation data emerges, perhaps we haven't seen the low in inflation, and there might be more adjustment in terms of Fed policy and things like Eurodollar futures contracts. And then you could see the opposite too. If you do get some growth scare of some kind, the implied rates have moved up enough such that there's actually plenty of space for them to come back down. In other words, the market can take these policy tightening expectations out should there be some faltering of growth. So it's pretty fascinating how two-way the surface is.
Yeah, listen, I think also there's an old metaphor that volatility is like a spring, right? The longer and harder that you coil it up into potential energy and compress that spring into potential energy by suppressing volatility, the more kinetic energy is released once that spring is finally allowed to bounce out. And that's more or less, I think, what we're seeing in fixed income vol to date. What I think is interesting, though, is that insofar as fixed income is, if you will, the foundation of the entire asset market building, it's kind of remarkable that we haven't seen more volatility in other aspects of sort of the global capital structure, given the amount of fixed income vol that we've had. Equity vol is kind of like the top of the skyscraper, right? And as you may know, skyscrapers are designed so that they do sway a little bit in the wind. Same principle as trees, I think. But you kind of want your foundation to be pretty rock solid. So given that we're having this almost earthquake in the foundation of global asset markets, you have to wonder if there isn't going to be more damage wrought sort of further up the building as time passes.
Well, I wanted to spend the last 10 minutes with you really getting into your writing. You're an author, you're publishing with consistency, and you're using as the backbone for your pieces the terminal itself. And so I would love to just maybe starting from the top as you think about idea generation and how you come about arriving at a specific topic and the process you go through and how you engage with the terminal in order to substantiate sometimes your initial prior, sometimes refute what you initially thought to be true. Walk us through just your idea generation process.
It's useful to take even a step further back, which is kind of the overall philosophy. And I think you probably, judging from some of the Twitter posts I've seen from you, I think you probably have a not dissimilar philosophy. And I think a lot of macro people do, which is ultimately that history may not repeat, but it often rhymes. And so we can distill lessons about how markets have responded to stimuli in the past to get some sort of idea of how they will respond to similar stimuli in the present and indeed in the future. And as part of that, I certainly as a PM and now as a mirror pundit, I've kind of developed a mixture of sort of quantitative and qualitative techniques that I try to blend in the sense that if there is a relationship that I think is broadly stable, well, rather than having to check on it sort of sporadically every day, every week, or every whatever, why not just articulate it mathematically and code it up into a model? Something as simple as what's the equilibrium level of the 10-year yield given certain economic and financial drivers is a sort of a classic one. Does the model always represent reality? No, of course it doesn't. And that's where sort of the qualitative overlay comes in, is to know whether there's something that the model is not capturing that's actually driving the market, or whether there isn't, in which case there's a potential alpha situation there, the deviation between where quote unquote equilibrium is and where the market is trading, albeit with the knowledge that, as Keynes famously said, the market can remain irrational rather than any of us can remain solvent, trying to play some sort of mean reversion to rationality. So I've got a number of models that I use, some of which attempt to ascribe a valuation, an equilibrium valuation to the market, some of which are merely descriptive of market behavior. Things like looking at liquidity in the stock market or the fixed income market, because to take an investment view, which is not what I'm doing, here at Bloomberg. But to take an investment view, which is what I'm hoping many of the readers do, you not only have to have a forecast about where something is going, you have to have an idea of the path that it will take. Is it likely to be a smooth line, or is there going to be a high amplitude of returns, i.e., a volatile environment, in which case your ex-ante risk-adjusted return is lower on the one hand, and B, what are your entry and exit costs, which is liquidity. So obviously, an environment with a high expected return, a low expected volatility, and relatively seamless transaction costs is an ideal investment setup. And I try to focus where those are in play, where appropriate. On the other hand, if there is a broad market trend, but it coincides with a low expected return, a high volatility environment, and extremely high transactions costs, I also try to identify those as well, because successful portfolio management is not just about your winners. It's obviously also about managing your losers and managing your risk, which I know is a subject near and dear to your heart. So I try to give readers not only an idea of where something is going, how it will get there, but the risks that are embedded along the way in the path, whether it's an amplitude of returns or whether it's a costliness of getting in or out of position.
Well, it seems that that focus is really on identifying these incongruities where asset A and asset B have some basis of relationships, perhaps financial, economic, and then certainly the history of the time series demonstrates a fair degree of overlap. Could be credit spreads versus the VIX. There's a number of these relationships. Are there any in the set of things that you look at now that just feel especially incongruous, where you're kind of scratching your head and saying, boy, this A versus B, that relationship has become pretty untethered relative to history?
The poster child for that is equity valuations and inflation. There's normally a pretty good negative correlation between the rate of inflation in the United States and the earnings multiple of the S&P. Some might say it's a spurious correlation. I don't know. I've got a model that uses not just inflation, but some other macro factors as well, which is kind of based on a model that GMO developed on the S&P multiple. The earnings yield is actually how I articulate it. And the conclusion is broadly, unsurprisingly, the same, that given the macro volatility in terms of economic data, and even adjusting for the level of yields, the multiple, it looks awfully high.
Talk to us more about some of your work there and how you've tried to quantify this.
Yeah, well, kind of my favorite one-stop shop market timing, macro market timing indicator for the stock market has traditionally been the real earnings yield of the S&P, which is sort of the inverse of the PE ratio deflated by headline CPI. Back when I was managing money, I had a sort of an equity allocation model, and this was part of it. Now, if you go back over the last sort of 35 years, heretofore, every time that the real earnings yield went to zero, we pretty much had a significant equity drawdown soon thereafter. It happened in 1987, it happened in 2000, and it happened in 2008. Well, that real earnings yield, obviously, given that inflation is so high, is now at the lowest level on record, minus 4.2% as of the last data. And that goes back to sort of 1954. And yet we have had a few gyrations in equities, but not what you would expect based on this historic relationship. Now, one explanatory variable, perhaps, is that monetary policy is still very, very accommodative. Bond yields have risen, but they still are quite low. And obviously, the balance sheet expansion has put a lot of liquidity into the system, even if a lot of it is sitting on the Fed's own balance sheet in the form of bank reserves. But it does raise the question about whether we might have a sort of a disproportionate impact from Fed policy on financial markets and on the equity market if and as some of this liquidity is withdrawn and as yields become a little more competitive vis-a-vis equity valuations. We're now, if you look at the nominal earnings yield of the S&P and compare it with the yield on a corporate bond index, investment grade corporate bond index, that's as tight as it's been in a dozen years. So there is some explanatory power in looking at that relationship when equity yields are relatively low compared to corporate yields versus, say, the last year or so. you tend to see a substandard return for the equity market moving forward. So that is certainly a risk from a sort of quasi-tactical, quasi-strategic perspective.
You mentioned three other times, 1987, 2000, 2008. So all these are quite interesting. Of course, 87 is a cataclysmic one-day decline, but just an incredible increase in real yields in the period preceding October 1987. What of those three previous periods does this period remind you most of now? Where's the corollary, do you think, strongest?
Well, I suppose the obvious one would be sort of the 2000 episode, where you were obviously at the tail end of an extraordinary equity rally driven by extreme valuations in the speculative grade stocks. I've got another metric that looks at what proportion of the equity market's valuation is not explained by 3 years of earnings expectations and book value. And I kind of fancifully call this hopes and dreams, because they essentially represents the hopes and dreams of future earnings beyond sort of the immediate forecast horizon. And we're more or less at the highest level since we were at the peak of the dot-com bubble. And you obviously have the Fed moving interest rates after a crisis, much as you did in 99 and 2000. The difference obviously being that we're coming from a much more accommodative base now, and the pace of change is going to be more aggressive.
Well, let's finish on some of the implications for curve relationships across geographies as a function of the speed with which central banks are taking back accommodation. So we talked a little bit about the kind of forward curves in Eurodollars versus Euribor. Dive into this a little bit more and perhaps bring to life how the terminal itself is your friend in isolating this relationship, the types of commands that you're able to utilize on the terminal, and then just the math of what you see in terms of this anomaly that you see.
Yeah, okay. Back when I was trading, I used to love these sorts of intermarket spreads. I think by and large, I had a sort of if you will, a long vol bias, whether that came from owning options as a way of articulating a view, or having, if you will, a sort of a momentum directional basis to a lot of my trades. But these sorts of RV relationships are, if you will, much more of a mean reversion, vol selling type strategy. So they were a nice offset to the overall bias of my book. Now, in terms of how identifying them, obviously I've got a launch pad, like I guess many others, that have all the contract prices listed. And then I'm sort of the king of CIXs, which is the custom index function on Bloomberg. I think most people are sort of topped out at 1,500 that they can create, but I guess because I work for Bloomberg, I can do as many as I like. And I think there's 20 of them to a page. And I've got like 126 pages of CIXs. So whatever that is, about 2,500 CIX that I've created. And so I've got different custom indices for a lot of the calendar spreads within a single market, say second versus sixth contract in Eurodollars, or the fourth versus the eighth contract in Euribor. And then I've got other CIXs that compare, say, the second versus sixth in Eurodollars versus Euribor. So it's just a very easy way of sort of graphing these relationships. And pursuant to the spread that we were talking about minutes ago, it's really interesting, because as the market became convinced that the Fed was going to start putting rates up more aggressively, there was this sort of mentality that more tightening now would imply less tightening later. And that essentially has followed through, because we've seen market pricing sort of telescope, with the peak in rates coming sometime around sort of the end of summer, early autumn of 2023, and then obviously pricing rate cuts thereafter. Whereas in Europe, that hasn't necessarily been the case. If you look at the sort of the terminal rate in the end of 2024, it's pretty close to the peak rates that are priced for the ECB. That having been said, I think there's an argument to be made that that will change, because some of the recent rhetoric we've had from a number of ECB speakers is suggestive that they're going to move more quickly than perhaps they'd indicated before. There's been a lot of talk this week about ending QE essentially as early as possible, which would be July, and perhaps even tightening quickly thereafter, again, as early as July. And I think the theory there would be that the more they do now being over the next year, the less they'll have to do later. In which case, does it make sense to say that the ECB would hike rates by 75 basis points more than the Fed in 2023? Well, quite possibly not if they are moving more aggressively in 2022. And I can't remember if I mentioned, but if you look at this third versus seventh contract spread, which currently works out as DEC 22 versus DEC 23, it's something like 75 basis points Euribor over, and it's never, ever, ever been that high since Euribor started in 1999. So that's the sort of thing that when I was running money, I would certainly pique the interest. And then if you're a fixed income guy, the obvious next question is, how does it carry? And it carries pretty darn well, because the next contract spread in the second versus six is like 36 ticks tighter, which is always what you want to see, that the roll is your friend rather than your headwind.
So big picture, one last topic, which I think just be great to get some of your thoughts on. Thinking about March of 2020, and of course, when you have a sudden stop that is imposed on the economy as it was, you're going to get a big asset price reaction, no doubt. There's no way the VIX isn't going to go into the 50s and 60s and so forth. And of course, it got to 80. There was an absolute breakdown of the bond market itself. The bedrock, as you say, of the system crashed or was about to crash unless the Fed did everything it could to revive the patience. So, of course, there's going to be a lot of volatility. But since the patient's been revived, we've also seen just nearly outrageous tail events. Crude went negative 35 on the front month future and then went to 130 a couple years later. Nickel, they had to close it for a couple of days. The GameStop incident. There's just been some really almost absurd tales to the left and right. And I'm just wondering if you can share some of your perspective on this. Are these related? What does it tell us perhaps about the fabric of the system? Is it something that we need to closely monitor? Because when asset prices get volatile, crazy things happen. How do you think about some of these post-COVID shock events that have materialized?
I think ultimately they reflect the financialization of the system, in the sense of certainly like the treasury market distress around COVID. That was centered on the notion of balance sheet. All the RV guys suddenly didn't have balance sheet and had to vacate their positions accordingly. And the thing with financial repression that we've sustained on and off for the last really 12, 13 years is that by kind of reducing the risk-free rate, the authorities, and ultimately by reducing volatility, the authorities have encouraged leverage throughout the system. And the problem with leverage throughout the system is that it works great as long as volatility is low, as long as funding costs are low and stable. But once both of those, or really either of those factors starts to change, then leverage can sort of turn on itself. And I think that's one of the reasons why we're seeing so many of these dislocations. USO wasn't levered per se, but it was still ultimately a volatility selling instrument insofar there was an element of maturity transformation that was involved in the way that it was structured and the way that it rolled. And essentially, the way you make money with leverage is by selling volatility. And the way that the authorities have incentivized people to take on leverage and sell vol is sort of individually rational, but quite possibly collectively irrational. And I think that's got to be the great concern about all of this is not sort of the known vulnerabilities, but the unknown vulnerabilities that are implicit in all this leverage in the system and all this volatility selling in the system. And going back to the point about all trades or all strategies either being vol selling or vol buying. The problem arises when people who've sold vol without realizing it suddenly discover that they're short. And that, for example, was the case with USO.
Right. Yeah. And I like the reference to financialization. I think you're right. That's a big part of it. And certainly is going to keep things interesting because the trend towards greater financialization is happening in the traditional financial economy, and the new age of digital asset economy as well is very predicated on the notion of financialization. Well, Cameron, this has been great. I want to, again, thank you for taking the time to be a guest. I love the insights. It's great to catch up with you, and I think our guests are going to enjoy this one. Thank you.
My pleasure.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.